concept of robo-advice. We hear an awful lot about it. Is the focus more on the robo side and less on the regulated advice, or am I leading the witness there?
You're sort of leading the witness a bit, and hopefully the FCA aren't in the room. We tend to take our clients on a journey with us. So it's not a case of being Steve Jobs at Apple and saying this is what you're going to do, and if you don't want to do it, go somewhere else. It's a case of trying to show them that this is the right way to engage with us. Now, we've got a broad range of customers, some of whom don't even know what the internet is, or let alone what a computer is, but they have a relationship with us. We tend to look to the US a lot for inspiration. There's lots of things you can say about the US, but actually in terms of financial services and innovation in financial services and the use of technology in financial services, they are excellent. You know, Charles Schwab and the way that they've transformed the Charles Schwab business is amazing. But we came across this business called United Capital, which is run by a fellow Zimbabwean, Joe Duran. And Joe just starts his business with a single premise is, am I going to be okay? Will I be okay? And if you can answer that question, then you're on the path. And all he did was he put a cash flow modeling tool in front of a client and said, how much do you earn? How much are you going to spend? How many dependents do you have? Etc., etc. And in essence came up with a plan. And the plan was you actually need to save more or you can't retire till you're 90. You know, just choose what you're going to do. But he coined this term bionic advice. And that's really what we're doing at Kirk & Co. We're taking the best of technology and the best of humans to create a bionic advice environment.
And I think going back to that, it kind of does, because going back to that book, it talks about within possibly 2 or 3 years, it starts talking about microbots within human beings as well. So that bionic part does resonate. The Gowan Jelf, just before the break, mentioned the revolution in the biological sphere as well, the life sciences sphere. So yeah, it does resonate very strongly.
There are so many things you can do. I mean, we're not going down the chatbot route and all of that. There's no need to do that if you've already got a team of advisors. But what you're doing is, with Silo, and I'll very briefly, because I know the other guys want to talk and I don't want to hog this, but very briefly, Silo is just an app. And it's an app that you link to your bank account. And there's others out there. There's Moneybox, there's in the UK, there's Wealth Simple, there's Wealthify, there's so many of them. What we do is we just encourage people to save what they think they can save. Don't try and be all macho and testosterone-filled about it. Don't try and save £1,000 a month. Try and save 50, 100, 200 a month, whatever you can. And then what we'll do is we'll link to your bank account, and just using an intelligent algo, we'll analyse your spending. So we'll analyse your income, we'll analyse your outgoings, and we can link more than one bank account, and we can link your credit card. And we can analyse your spending, and then we can just, based on the current balances that you have, your previous expenditure, what we know you're going to spend, actually we can then say, you could save more money this month or this week, and here's a suggestion to save more money. So that's what Silo's all about. But actually, in order to make it work, you have to drive cost out of your business model. And so we rather stupidly decided we'd build our own blockchain back office, and I'm happy to talk about that.
So that's got to be an offline, because I know that's getting back into it. Phil, taking cost out of the business, I know you've been passionate about that for quite some time with a lot of heads. Do you want to just tell us, about any cultural shifts, since you've been through Barclays on the wealth management side and also UBS, but also going through the other experiences which you've had prior to Seven?
Yeah, I think if you look at the wealth management industry, there's a couple of really key principles, which is, number one is look after people's money. And number two is do it as cheaply as possible. And so I think that drives the way in which we behave. But to Clem's point as well, and there's a couple of interesting things that have gone on in recent time. Pension regulation changes have really made a difference, and that's something we're now having to face. So people used to retire and take an annuity. So effectively, they came out of the wealth management industry and went to the life company and got their monthly payments. But as you all know, the annuity industry is probably dying, I think is a fair way to describe it. And the annuity rates just aren't worth the paper they're written on. And what that means is what clients are now doing is they're staying with us. and actually they're still investing in their pensions. They may take some money out of their pensions, but they're still investing it. So one of the things we've been doing is setting ourselves up as a pension company. Because now we know we've got these clients who may have disappeared, but they'll be with us for another 20, 30 years. One of the great things about the pension industry is probably it's the most backward of most of the industries, so you probably experience this in yourself. If you've got some old company pension or something, if you're lucky, you'll get a letter once a year that tells you something on one piece of paper that you can't understand, and that's it. That's the service you get.
Sorry to interrupt, to cut in there, but do we ever think we're going to invert the paradigm so pension companies actually instruct us, keep us appraised of what's actually going on?
Yeah, because we're going to be one.
At the moment, the workflow is all, the work's with us. It's a bit like the supermarket example, the FMCG example, but the customer having to do all the work.
And also, you should be able to check it any time you want. So you might want a bit more out of your pension because you're doing something, but you'd probably like to check it. So a nice online app that tells you that you can do that or what it means. Because at the moment, if you deal with a pension company, you get once a year, and if you're lucky when you talk to them, if you get any more information than that. So that needs to change.
Can you elaborate a little bit more on the gaming? Because I've been at a couple of wealth conferences of late, wealth and private banking conferences. There's a big desire to basically pick up on what is going on in the gamification in other sectors, if you like, and taking some of those techniques into private banking, wealth management. Is that really where you're coming from?
Yeah, so it's enabling people to, in an easy-to-use interface, put in those details about what they have, what they've got, what their plan is, and be able to present that back to them in different viewpoints that show them what they're likely to need or whether they've got a shortfall. It does things like rotating globes to show them what they could be invested in. So it just makes it much more appealing and visual and easier to use. But it's a start. I mean, we're on version 1, and we probably need to get to version 10 before I think we've got a reasonable application.
Phil, that's, one thing I've got a question on is how the move into both your technologies, right? How's that going to impact the rest of the business? So custodians, brokers, etc. Is it going to have any impact? And how will that manifest itself?
Good question. And the simple answer is yes, of course it does. And to Clem's point, everyone in the wealth management industry is more or less using 1970s, 80s technology to underpin what they do. Not dissimilar to banking, really. But that, for me, has to change. And like Clem, I think we as we go forward, we have to change that. Unfortunately, it's not really a sexy part of the business, so no one gets excited about it. But we have to accept if we want to drive cost, we have to apply resource into those areas as much as we do. And like Clem, I'm looking at some of the back office stuff as well. So it's a real balance of things, because obviously you're always trying to give your customer the best experience possible. But you know, if you don't change yourself as well, you won't change enough. And just on innovation, I mean, I don't think, for me, innovation isn't a department sitting somewhere. It's a way the company works. So innovation should be happening everywhere, and we should encourage it to happen all through the business, not just at the glossy front end, if you like. And so that's what we're trying to do as well, to try and drive change in a way.
Yeah, I mean, Silo as a project is exactly about innovation across the whole business. It's not about just doing one thing and hoping that solves a problem. It's about the whole business. But as to your point, I mean, I was asked the question a while ago, am I going to cannibalize revenues by having an app that is a lower cost potentially than the existing Killick services? Well, the short answer is no, because our existing clients don't necessarily want an app, but it's all about intergenerational wealth. So it's about saying to, you know, the head of the household, whether it's the great-grandparent or the grandparent or the parent, you know, start thinking about what you're going to do with your wealth in relation to the rest of your family, because there's some really sexy tax-efficient ways of handling all of this. And if we provide, like 7IM, that suite of services that spans the generation, the money is never going to leave the firm. It's going to stay with the firm.
And I just want to pick up one thing on robo-advice, because it's always interesting, having been at the, if you like, the forefront of it. When NatMo started, there were no robots and there was no advice. So it's pretty weird why we were called a robo-advisor. And the honest truth is, when the reason Nutmeg went into advice is because the FCA told us to. So we viewed ourselves as an online discretionary wealth management company, but in the end the FCA didn't quite like that description, so, and hence there is a bit of advice. But to be honest, those new companies are mainly dealing with applying a risk portfolio to a model portfolio. And there's just some algorithms that enable to convert the money into investments. But there's no real robo-advice going on, just so...
It is possible to basically get millennials very excited about investing, as we've seen with cryptocurrencies. I mean, it's interesting if the mood music is out there and they can see a lot of action in Ethereum or Ripple or Dash or Zcoin or whatever, you can get them to focus. So I think innovation, I strongly agree with the statement, it could and should be part of every scorecard and everything we do.
But just talking about the millennials quickly on,
Yeah,
the problem with the millennials is they haven't got much money. And therefore, even though they use, and I talk to a few of them as I do, and so when you talk to them about using, so when they put 100 quid in Nutmeg, it's not very exciting. It might move a quid or something. So they don't get it. Because the bit they don't get is the bit that it's really hard to explain, that putting money away now for 20 years is what really makes a difference. And I don't think anyone's cracked that in terms of a way of explaining that to that generation.
By the way, that's supermarket thinking as well. You know, get the customer in really, really early.
Well, it's sort of deferred gratification.
It is.
And trying to tell a 25-year-old that, you know, put off, you know, spending your money now because you're going to have lots of money in 30, 50 years' time.
When you can't
It's
walk
not
properly.
sexy.
And,
It's not sexy. Let's have fun now whilst we've got the money.
Speaking of fun now, so the other day, the fun now for me personally was writing to my different pension companies and getting a load of bump. I swear to God, it was about 1/4 of an inch thick in terms of optionality, on the premise that the regulators think the more is better. Now, I'm going to hand over to Anthony here, and we're going to talk a little bit about the regulators in the midst of all of this, as I mentioned in the beginning. So, what do the regulators make of all of this, if I can be so bold? And is more really better? Does more make for better intelligibility of what is put out there?
Clearly, I've got the boring bit here, where you all fall asleep. And as both these two guys have been saying, as fast as we're taking cost out of the business, guess who's adding to it? The regulators. So not a great swap, if you like, of the cost base, not the most efficient types of swaps. What can I say about regulation that you don't already know? I mean, I feel your pain, frankly, significantly, having, you know, being on a couple of bank boards and having gone through it. And post-crisis, I mean, obviously the focus of the FCA and regulators around the world was on banking and strengthening banking regulation, particularly in the context of systemics. But it was inevitable they were going to move into other sectors once they completed that task. And guess what? You're one of the sectors that they've moved into. And I think there was an attempt, if I remembered correctly, to try and classify large commodity houses and large asset managers as systemic. Unfortunately, that didn't come off. There was a lot of resistance to that, and so that was abandoned. But nevertheless, asset managers came under significant review, and we all know there was a report last year which made slightly uncomfortable reading for some. In any event, what we're facing is a tsunami of rules. I mean, I don't need to go through it all with you guys. I mean, MiFID II, PRIPS, extension of the senior management regime, new governance rules, new conduct rules, and more to come. I mean, there is a lot going to come down the pike at everyone.
Anthony,
Never mind
sorry,
Brexit.
just very quickly, there's been a lot of talk by the regulator here about value for money and the asset management market study, front page news on FTFM this week. Is that a growing trend that regulators are thinking about the effectiveness of the measures?
Well, you have to go back to some extent to how the FCA originally described itself, which was highly controversial, and it called itself, I think it was called the consumer champion, and everyone got very angry about that phrase. Now that psychology remains there, and this is not to say that they are wrong to focus on culture and conduct and returns and good customer outcomes. But the worry factor is, when you talk about good customer outcomes, for example, does that sort of migrate to saying, well, investments must not be allowed to lose money? And there's a bit of that sort of thinking going on. They would deny it vehemently, but if you look at what's happening to, for example, retail CFDs, they're talking about any loss, firms are going to have to guarantee it. So, I mean, there's a real risk here that we can go too far down that route.
Absolutely. And with the FCA also having a competition agenda.
But I
Well,
also...
let me come to that, because particularly in the context of the asset management industry, because we all know that the UK is more than the size of the next 4 countries, which is Germany, France, Netherlands, Italy. It's got about well over 30% of asset management businesses based here in the UK, and 50% of that asset management business, I think, comes from overseas. It doesn't come from domestic providers. So coming to your point about competition, if there's one thing I would say to everyone in this room, say to all your trade bodies and everybody else, you may remember that I think it was at the start of the FSA, there was a cri de coeur saying that the regulator, the new regulator, must take competitiveness into account when it's writing rules, when it's developing its regulatory policy. The industry lost that battle. With Brexit on the doorstep, new legislation coming back, we have to go right back into that battle. And the touchstone is the government's constant promise that, oh yes, after Brexit, the UK is going to be internationally competitive. The government has got to read the riot act to the FCA. And it's got to do it for another reason. And that is, don't forget, for 40 years, and I say this with great respect to the FCA, but they've had no choice. They've been a rule taker from the EU. The psychology, yes, they've had tremendous input into the rules in ESMA and elsewhere, but the psychology is once those rules are finalised, guess what? We have to put them in our rule book.
So there's a huge benefit post-Brexit, and we're going to
Post-Brexit,
hear more about this
can that
afternoon.
culture really shift into becoming a sovereign, independent, free-thinking, proportionate rule maker as opposed to a rule taker?
Absolutely.
That's going to be really important.
The other problem with the regulator is that there used to be a flow of experience out of the industry and into the regulator. In the last 10 years, there's been a flow out of the regulator and into the industry. And the industry has done that to protect themselves. So get the experts out of the regulator to help us with our business, our own individual business. So what we're left with is a bunch of bureaucrats, who just take the rules from Europe, gold plate them, apply a British logic to it, and say, here you go, industry, get on with it. And it's just not right. And we just can't accept that anymore.
I'd say that's a bit harsh, because I think sometimes behind the closed doors of ESMA and IOSCO and elsewhere, the FCA has actually tried to fight a good fight. But most often or not, they lose. But they have actually tried to be a balancing regulator, putting in some input into some of the EU's more extreme thinking.
Anthony, you and I have been there with David Wright, etc. And we've heard a little bit of the mood music for a while. Sorry, quick question.
I'm coming.
Sorry. Then I'd like to get a couple of votes to involve the audience a little bit more. I'm just conscious of time as well.
I was going to say, I think I've said this before, we continually shoot ourselves in the foot as an industry over everything, not just banking, but financial services and everything else. And this, where the FCA's evolved in the way it has, potentially because the politicians are looking for vote winners, and every time we screw up, or we screw a customer, the industry and everything else, the politicians come down heavy on us. We still have that situation, which is why we're in the situation we are now, where the FCA is regulating, protecting the consumer, down to the ridiculous part of we can't lose money for our clients, because the whole trust has gone. And until we build that trust back up, until we have that conversation, until we get the politicians educated, until we get people educated with financial education again about the value of money and planning and everything else, we're just in this never-ending circle that we're not going to get ourselves out of.
Actually, you know what, I'm really glad you mentioned the T word in terms of building up the trust, because I'd like to get a vote on the technology, and also whether the technology, like blockchain, is meant to be described, according to The Economist, as a trust machine. whether the technology will actually help us get there. If you look at, let's say, the options, I picked 5, I could have picked slightly more, and they all mean different things. Please do vote in terms of robotics, which is, I understand, to be robotic process automation, so a bit like STP for this decade. Robo-advice tools, as we've heard from the panel, artificial intelligence, cognitive computing, machine learning, that kind of thing. Predictive analytics, and lastly, blockchain, distributed ledger technology, supported by smart contracts.
If anyone's got any problems logging in, please let me know.
Seeing a lot of green behind me, which I think is AI, is that correct? Stuart, is that correct? Okay. Right. So I'm giving us an approximate, it's in green and purple out of the corner of my sort of very peripheral vision. AI and blockchain. Claire, Phil? Expected sort of answer. So let's keep that at the back of our minds. And for the second vote, if I can take that, if I may, which new initiatives would be helpful to help wealth and asset managers specifically manage complexity and reduce cost-income ratios? So for those in the audience who are not less familiar with the model, cost income for a typical wealth manager could be around 60-70%. There's talk of Chinese banks having cost incomes around 30%. Is 60 to 70 way out of whack? And are there any initiatives which are going to help the wealth asset manager community reduce those cost bases? So product offerings, market infrastructure utilities, as we've heard in the earlier session, prevalence of managed services like documentation handling, market practices to improve front office, front of house, and lastly, utilization of standards, which we haven't heard yet, if I'm right. Nigel, I think you mentioned the S word.
Yes, we have. We did earlier on about data standards and standards in terms of APIs and things like that. So moving that whole model, yes, we did, yeah.
Interesting. So how are we looking there? Seeing purple again, I'm seeing a lot of red here on the infrastructure side. So a combination of infrastructure utilities, and I think I've sat at a few events where that's seen as a brave new world, and standards, which is ever present. Thoughts?
Thoughts? Well, I mean, artificial intelligence, a lot talked about that. A lot of noise, I think, still about artificial intelligence and deep machine learning. Yes, I think it definitely has a place to play. Deep machine learning, though, is quite a tricky thing. Google have been mucking around with that for some time, and they've turned it on and off and on again. And one of the reasons they've done that is because they actually don't understand anymore what the machines do. So that is a problem for us in deep machine learning. We don't no longer understand. So originally artificial intelligence was built around, so if you used to take a picture of a cow, so how does a machine recognize that's a cow? Well, what they used to do is take loads of pictures of cows, and then over time it worked out some parameters and said that's a cow, whereas it's now much more rule-based what's going on. So, you know, it's got 4 legs and it's got a face like that and it moves or whatever it is, and therefore it starts to make its own decisions. It no longer leaves that pile of data behind it. So that will come into our industry, but the danger with that is we don't know. And anyone who's been around a bit of time, like us up here, I remember I think it was 1999, long-term capital asset management. Everyone remember them?
Yeah.
Couldn't go wrong.
Yeah.
All of them were PhD professors, etc. Couldn't go wrong. And guess what? It did. And all the banks lost a lot of money.
Yeah.
And so I think we'll be very wary of this stuff and understanding, because there is things that we can do as humans which we mustn't forget, which is we can take in data very quickly in a difficult situation and find a solution around it. And that's, I think, we've just got to be careful not to over-rely on the artificial intelligence.
Before I bring in Clem and
Tony, sorry, just a question, sorry.
Sorry, just going back on that, sorry, it's me again. You were talking about trust and technology. I don't think it's a technology thing, it's a people thing. It doesn't matter what the technology is, we're competing against, as you say, things like long-term capital management. We're also talking about fictitious things, so things, you know, you just need to read programs like, or watch programs like Mr. Robot, any CSI program at the moment. The worry is about hacking, the worry is about unscrupulous providers of those services using that data in the wrong way. You know, these are the things that are the problems. The technology is not the problem, it's the trust of the people behind it and are doing the right thing for the person. And I think, again, going back, we have lost that trust of everybody, whether that's an investment bank, a broker, anybody else. Everybody at the moment sees us as an industry that makes money for ourselves and no one else. Because whatever it is, you know, we resolve these problems. You know, in investment management, there's arguments about commissions that are being hidden. And then there's arguments about when the legislation comes out, we argue about it, and then we find that some people are actually abiding by the rules, others are just changing things. You know, we do it every time, and we need to rebuild that trust.
Yeah, look, I agree with you. And I think there's a real problem here because, first of all, it doesn't matter what sector of the industry you're talking about, they're always seen to be dragged kicking and screaming into good behaviour by regulators and others. That is a very bad image. We should be stepping up to the plate and doing our own stuff, first of all, developing our own codes of conduct, but even more importantly, and this is where we've fallen flat on our faces, we don't communicate any of this stuff to the public. What do you read about? I mean, I know, you know, the popular dailies like all the bad stuff, but the reality is there should be much greater communication in the Sun and the Mail and the Mirror and all these other magazines and papers about what is going on, and there is some good stuff going on, but it never gets out there. So every time you talk to a consumer, you will say, oh, well, financial service providers, they're worse than plumbers and politicians, aren't they? You know, and that's because we're not really focusing on communication, marketing the process of change, and of course, we still get the headlines coming, and that doesn't help.
Just to pick up, you're mentioning we need to educate through the newspapers. Forget that. Social media. You've got to target a different audience. I mean, I'm just looking at everyone here, and you've got old-fashioned views. So please, you know, start looking at new ways, new targeting. We live in a omni-channel world. We've got to do things differently.
No, I agree.
But I think we all agree. And we use a lot. We're using a lot of media as well. So we get out in the media a lot. We get out in social media a lot as well. So we are using those new channels. But it takes time. But there is some fundamental things that, you know, you can go back. We can do all of that as well. But the fundamental thing of there is a real balance with young people about how much you can persuade them to save over what their lives are now. And that, you know, that's not going to go away. That is a natural behaviour.
No, last question. We've got a last vote.
Sorry, yeah, it's more of a kind of statement based on listening to what everyone's saying here. I'm not too far away from being a millennial, slightly over it myself, but I think one thing you've got to understand from that perspective, or younger generation's perspective, is our lives are completely different in terms of an outlook compared to my dad.
Of course,
right? You know, not for me as such, but when I was 16, 17 playing rugby, I'd have a beer afterwards, right? That was part and parcel of it. 16, 17-year-olds now that I play rugby with, they don't. They have a protein shake, right? They're worried about their health. It's very much in the news. These guys are going to live longer, okay? They grow up and they're understanding that they're going to have to retire later, that they can't afford a house. So perhaps rather than just changing the FCA or the regulator's attitude, perhaps the industry needs to evolve. And I agree completely with you in educating people, but also to try and make things more specific to these individuals. So, you know, people are worried about affording a house. You know, so is there not something that the asset management industry could do to perhaps say, okay, we'll set up a fund for your children, you know, invest 20 quid a week, 50 quid a week, and this is going to get them to this point by the time they hit 18, even if it's enough for a deposit. That's a huge difference. So it's maybe looking at it differently in how you can seize opportunities from this rather than just sort of saying, let's do the same thing we've always done.
Solcombe Bartley-Guard, so I agree with everything Rippy said. I'm actually a millennial. So I think the fact that our generation, I'm going to tar a millennial now as lazy. They like to have things done for them. So when the vote was earlier, I was sort of in between robotics and AI. If I can get a text when I spend some money and they say, you could invest this in X, Y, and Z, and that in 10 years' time will equate to this. I think having that automated process will make a big difference to the mindset as well. Because like you said earlier, Anthony, about the fact that we don't know what to invest in, but then Bitcoin and Ethereum and all this has come through and it's really exciting, that's because people talk about it all the time and they have apps for it. It's on social media. Yeah. So I think going back to that whole mindset piece and not necessarily the regulators changing it, it's about how we, as an industry, can actually change the mindset and have that real instant gratification of you saved £10 this week.
I've given my children financial education. I've spent 32, 33 years in the banking industry, and my financial education came from working in the banking industry, and I have made sure that they understand But in their schools, they have no concept of what a checkbook is, what a direct debit is, what a bank account is, how you should invest, how you should spend money. You know, the closest they came was my 26-year-old, where they played a game. I mean, yeah, okay, you can laugh about a checkbook. It's still there, it still exists. But it's not about, it's going back to the absolute basics of when you leave school at 16, or before that, when you're 9 or 10, you need to understand what money is and what this gives you in your life. Because you can come out of school and you'll never understand, and whatever we do will never work.
Nigel, is there time for any more questions?
Yeah, you can have one more question.
One more question from the audience. Don't be shy. So I might even throw a vote.
What I will say while you're thinking about a question, you'll hear about the ISITC Europe Academic Forum. Okay? This is our little bit of trying to educate the industry and bring that knowledge base back into universities and the other way around, and access the research opportunities that lie within those universities. So for me, that's our little bit. The guys that I mentioned up here, they're already doing their bit in terms of, you know, allowing education on their own websites and going around to the schools and colleges. I hear what you're saying.
Sorry, hi, I'm Callum, Colt Technology Services. Just as a kind of, I guess, millennial myself, we were mentioning about kind of print textbooks, but in an age where, you know, you can access all this information so easily, do you feel that, obviously, and for me, myself, I haven't had much financial education. I come from a technology background, I did a business degree, still don't know a huge amount about finance. In an information age, do you feel like it would need to be through textbooks, or, you know, as we mentioned, there's applications, applications like Monzo or Revolut who will help you track your spending and things like that, and they're becoming more popular. You know, does the need for a textbook fit in with the way that we take in information?
Any last comments from the panel on that one? I know that's
I agree with you. I don't think textbooks do. So I think it's a technology delivery of information that we need to work out. Because all these guys are going to be, but by the time they grow up, they're going to be using technology.
a very quick killer question. I'm interested in Clem's view on this, and Anthony's as well. If I'm a tech company, fintech, for example, and I see the extent to which firms get fined, do I want to wander into this industry and intermediate? Do I want to be an enabler to this? Or am I leery about basically entering a very regulated industry where the fines are really quite significant?
I think if you're providing the software to the end user, as long as the software is doing what it's supposed to be doing, then you've ring-fenced the risk.
I agree. You're not in that space.
I think of the data protection reg coming down the line in May, for example.
Well, there is that.
There's some big stuff there.
Can I just, my observation on the industry and education and everything else is we need to be aware that, yes, the Monzos and the Revoluts and others, the Starlings, etc., have come to play. But it's when Google and Amazon and Apple and Facebook and others decide that they want to be in this space, they are the guys who are going to take the industry forward. Because
G-Coin, all this sort of stuff.
They've got the wherewithal to do all of this. Gotcha. And all we're doing is we're just trying to provide a structure, as I said earlier, to enable people, to give them the ability to use our services to help them save. And it's about saving and investing, really.
And Anthony, as a close, do you think the government and the other bodies, do you think they're getting what we're talking about as well?
Oh, look, I do. And you know, we talk about reg tech. I know that the FCA is getting more and more focused on that. So I do think the regulators and the government are moving forward. But how ruthless and determined are they going to be on delivering on all this stuff? That's the real question. It's not, do they get it? They get it. But what are they going to do about it? And that I think is part of the problem.
Many of the tech companies aren't clear.
Yeah, that's part of the problem.
I think that's probably out of time, aren't we, Nigel?
Yep.
I want to extend, but I just want to thank the panel very warmly. That was quite a debate jumping around. I'm sure you're going to have comments and questions over the lunch break to use as well. So please do applaud the panel and the customers.